Hello, everyone. My name is Stephen Hilborn. This is week 2 of financial management. Thank you so much for bearing with me while I combat this COVID illness. As you can hear, my voice probably, I still lose my voice a little bit from time to time, but hopefully this will be okay throughout this presentation. So this is week 2. What we're going to be going through here today is a little bit more material in advance to our class, either on Monday or Tuesday. So this is Sunday here. I'll post it. If you can, please make sure you watch. I don't know if I'm reminding you during this, but if you can, please watch this before class. So I will have a riddle that we will talk about in class, but we'll leave it till then. I don't want you to get too far into that. Okay, so we're going to review last week just a little bit, and then we'll jump into the things that we'll be talking about here today. So first of all, last week we went through the 4 financial statements. Now let me say, you must understand these 4 financial statements. You will need to know what they look like. You will also need to understand that they don't always look the same based on what kind of business we're talking about. But there are very common factors, there are very common elements of all of these, okay? The idea is that if you start a business, you should be able to not only read one of these, but create an income statement, create your balance sheet. It is not as difficult as it may seem, and there are a million examples online and out there for you to review to make sure you're doing it correctly. Now, as we spoke about this before, income statement records the profit and loss of the particular period of time. Usually we look at week, month, quarter, then year. And then the balance sheet is the statement of financial position. So that's literally telling you at any specific time that you complete your balance sheet, how much money do you have in the bank? Usually we look at this like at the end of the month or the end of a quarter, but you can do it for January 17th randomly just to see how much money you're worth that day. The statement of the retained earnings is the kind of connector piece between the income statement and the balance sheet. The income statement shows the operations and the effect that it'll have on business. The balance sheet shows you the finalized after the effect of the operations. So this details the movement in owner's equity, the value of the company. So either your company's worth more money because you did well, or it's worth less money because you lost money. And some months you can expect a loss, and some months you're going to make. Specifically in our industry of seasonal fluctuations. So these 3 really go hand in hand. And then there's the cash flow statement, which is not necessarily one of these financial statements that you would need to report as much, but really a cash flow statement is more so budgetary, a guide, if you will. So ensuring that you know where the movements of cash are going to be happening and ensuring you have enough money to cover those cash movements. So labor is a big one as an example, buying supplies. Our money that we bring in is not always guaranteed to be regular, which means it's not, as a business, you don't get paid every 2 weeks like you would as an employee. Rather, you get paid when a customer decides to pay you. So if it's an accommodation and someone's paying for a hotel room, it might be at the end of their stay. But if it's like a conference, they might take 90 days to pay you. And in that conference, you sold 200 hotel nights, you sold lots of food and beverage, you had to pay for all of that up front, but you don't get the money until maybe 90 days. So that's where that cash flow statement really comes in hand to ensure that you can pay all your bills before you get that revenue. Sorry, my voice is going to cut in and out. We looked at the balance sheet. So what are assets versus non-current assets? And assets are usually something that we intend to use up within one calendar year. So this could be inventory, this could be cash, this could be any trade receivables. And then non-current is something that we usually have for a long time and we hope will appreciate, which means go up, and depreciates down, appreciate in value over time. And then we've seen this in accounting, you've seen this in all your classes. Assets minus liabilities equals total equity. That's something we need to understand. Assets minus total equity equals liabilities. That total equity minus liabilities equals assets. That's an interchangeable formula, so just understand that one. So this here would be another example of a balance sheet. So here it's showing all of your different cash, accounts receivable, inventories, prepaid expenses. These are things that we would consider to be current assets. We're going to use most of this up within 1 year. Now, that's the idea. And then you have these non-current assets with depreciation. Depreciation takes away from your current assets. So as an example, I have $300,000 worth of vehicles. Now, because they're vehicles, they depreciate in value as I use them up. So the understanding is that, yeah, while I had $300,000 worth of vehicles, my expectation is that that $300,000 worth of trucks will now be worth $100,000 less by the end of this year because of me using it. We're driving it, we're wear and tear, we're banging them up, the tires are going bald, who knows? And then we have our equities and liability. So sometimes they compare these because assets equals equity plus liabilities. So these are current liabilities, as we've looked at. These are all the things that we expect to have to pay within 1 calendar year. And then there's long-term liabilities, which will take many years potentially for us to pay it off. So that gives you an idea. And then what we're left out with is share capital. So share means the shares that the company owns. And let's just say they have 100,000 shares as an example. And how much are they worth? So if they're all worth $1, they are now worth $100,000. That's our share capital. Retained earnings is some of the income and money that we've held on to that we are not distributing to ownership. So just because you're the owner of a gas station, and you know what, you made $100,000. Well, I'm going to give you $20,000 as your ownership, but I'm going to hold on to $80,000 because we're going to have to pay for marketing. We got to put in some new pumps. We need a new cover over top of them. Who knows, right? So that retained earnings is keeping the money in the business for future expenses. Last week's example showed a basic income statement. First of all, we had revenue minus cost of sales. So the cost of sales, this is important to note, it's not an expense like other expenses. So administrative expenses, HR, those kind of stuff are expenses, but you can't necessarily tie that to a revenue. So revenue, cost of sales is an expense that is tied directly to a revenue. So if I'm a hotel, then my cost of sales would be the front desk labor, the housekeeping labor, the cost of sheets, hydro, water, lights, blah, 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 blah. All of these things that I'm attaching right to that revenue. So I made $120,000, but I spent $65,000 earning that $120,000. So I'm left with $55,000. Food and beverage is the easiest way because we buy food, we create dishes, and then we sell it. It's the easiest way to understand that. We might sell $120,000 worth of food, but the food and the labor cost is $65,000 to make that 120. So we're left with 55. And then we subtract all of the other administrative costs and all the other stuff. And that gives us a profit before tax. And then once we know what our profit before tax is, then we are taxed, and then we have a certain amount left. So this is the income statement in a hotel. So it's a little bit different because hotels have multiple streams of revenue. So yeah, I guess if you are a motel, you might only have one stream of revenue, and that's just selling rooms. But most places, motels are a dying breed. Most places now are hotels. They have rooms, they have food, they have beverage. They might have telephone or Wi-Fi or some other services. They have spas, they might have rentals, they have parking. There are so many different multipliers, we call them in the industry, that we have different revenue centers. So logically, we should also have expenses that are tied only to those revenue centers. So as an example, here showing that rooms, $15,000 worth of rooms, which make up almost 53% of our total revenue. We have food, which is 26%, beverage, telephone, spa, and some other. And it gives you the percentages of revenue of what we're making. And then you look to the departmental expenses. So rooms cost us about $4,000 to run. Now it's 26% cost. So this is a 26% is 4,000, let's say 4,000 of our 15,193. So saying we get to keep the other 74 in our rooms department. That's good, right? So we're spending about 1/4 of our rooms revenue on our expenses. Then you have food and beverage. We made $7,500 or million or whatever this is, but we spent over 7,000. So our cost is 78% of the food revenue. That's not good. So basically what we're looking at here is that we're only keeping 22%, and I think that math might be off a little bit as well. But we're only keeping 22% as an example. So obviously we have an issue with our food and beverage, but there's a lot of different moving elements here. You do have to understand, if we just say, okay, that doesn't make us a lot of money, let's get rid of food and beverage. Okay, so we get rid of food and beverage. Now all of a sudden our rooms rentals go down because there's no food and beverage at your hotel. So that turns off a lot of people from going there. Oh, I see. 78% is 7,000 of these two combined. So they separated food and beverage, which is about $9,000. So 7,000 is 78% of the total of 9,000 of food and beverage. That makes more sense. And then you have telephone, you have spa. Again, spa is a pretty high expense. 70% of the spa revenue is already taken up. But again, when you think about this kind of stuff, if I'm renting a room, it's not because the room is beautiful. It's because they have a great restaurant and a cool spa on site. So these are the things that draw me to make this kind of money. So this is how they tie in, and this is how it's important to understand that you can't just look at one individual department and say that's a bad department because they don't make as much money. You say, what is the impact of food and beverage on the room's revenue? What is the impact of the spa department on the room's revenue? And it's probably really substantial. At the end of the day here, we had $28,000 in revenue. We made $15,000, which is a 52.2% return on our investment, or that's how much of the revenue we get to keep. So that's those are departmental incomes. This is another way of looking at it. So this is a portion of the horizontal income statement. It's easier to see how the related expenses affect each department. So the term contributory income is the amount each department contributes. So dining room department, the banquet department, the beverage department. How much do these contribute to the total revenue? Sorry, I'm getting stuffed up here. So as you can see, dining is by far our biggest area. We have $202,000 in sales. Our contributory income is only $37,000 in sales. The cost is quite high. This is the cost of all the food. Wages and salaries are quite high as well, higher than anywhere else. And then also the other direct expenses, which could be linens and napkins and, washing chemicals for our dishwasher and all kinds of stuff. So when you look at this, if I had to say which department is doing the best, I would probably go to beverage, because I'm going to say we only had $90,000 in sales and we made $48,400. Now, again, it's not as easy to look at this and say which one is good and which one is bad, because they have a lot of different information that we don't know about yet. So as an example, beverage, the cost of sales is low, because when you make a vodka soda, it's 1 ounce of vodka soda and you're done. And it takes very little labor to create a cocktail or a drink, versus it takes a lot of labor to create a food dish. But the thing is, we won't sell any beverage, or we'll sell limited beverage if we don't have food to accompany it, right? The cost of sales, so we require a lot more dollars for food than we do for beverage. And as you probably saw in some of our previous courses, 30, 35, 40% food cost versus 10, 20% food cost for beverage. Wages and salaries, same thing. 1 or 2 bartenders can complete all this, versus you might need 6 or 7 backhouse staff. You'll need different dishwashers. You might need a chef. All of the different moving parts in the wages and salaries is a lot more steep than it could be for the bar department. But they work with each other. So departmental expenses are considered direct expenses, and we have direct expenses and we have indirect expenses. So these are the things that we need to understand when it comes to an income statement. Direct expenses are those cost of sales. They're the food and beverage, the salaries, the wages, any other related payroll expense. Could be linens, could be spa expenses. So soaps and lotions and towels and things like that. These are things that are directly related to those incomes or revenues, sorry. So this is the rest of that vertical income statement. So before we were looking at total department income, above this would have all of your different revenues, all of your costs of sales removed from it. And then finally, you just have your total department income of sales, food or rooms, food and beverage, spa, everything all combined. Then we have to subtract the undistributed or indirect expenses, which means things that we can't necessarily say that this expense belongs to this revenue. So administration in general, this could be general. This could be your general manager's salary. This could be just the cost of running the business licenses, the website, all that kind of stuff. It's $174,000. Marketing, property maintenance, energy. These are the total undistributed expenses. So they go here. And then we have some fixed charges. So fixed charges are things that we have to pay basically the same amount every single year. They might go up and down, but they go up and down yearly. So insurance for the place, property tax, interest, depreciation. These are our total fixed charges, which leaves us with $94,800. And if we're paying a 50% tax bracket, we would only left with $47,400 from $728,000. So we're not making a whole lot of money. So these indirect expenses are not directly related to the revenue. As I said before, undistributed or indirect are admin, marketing, could be utilities, right? Because your energy bill, it's not broken down by how much is feeding the rooms versus how much is feeding the kitchen. We just know it's one bill. So it just kind of goes against all of them. Management fee, human resources, and then the fixed charges could be your rent and your interest and your insurance and things like that. So this is the rest of a horizontal income statement where they just broke up in 3 different lines, all of the different dining, banquet, and bar. So again, this format allows management to see each department's performance, and then they subtract all. So here they were able to break apart some of the different administrative expenses, and we'll tell you how one of the ways or several of the ways to break apart these expenses against our individual departments. And they have security and franchise fees and all kinds of stuff. And then they have their gross operating profit, and then your fixed charges and net operating income, income before taxes, income taxes, net income. It follows a very set format or very set formula. And this is it. We start with our departmental revenues. Then we remove our direct costs, our costs of sales, our departmental expenses. That's all the same name for the same thing. It's the revenue, the labor, and the materials or supplies used to make that revenue. Then we're left with our contributory income. So what each department contributes. This is controllable by management, right? Direct costs, making sure that we're not wasting things, making sure we staff appropriately. This is the stuff that we get paid for. Then you have your contributory income. You subtract your undistributed expenses, which gives you your gross operating income or profit. You have some control as a manager on this. Not a ton, but you have some. And then you subtract your fixed charges, which gives you your income before income tax. And then you have to pay your tax. And then you have your net profit or net income or net loss if you don't make any money. You have very little to no control over this part, right? These fixed charges, that's the same amount every single year. Income tax, that's set by government. We don't control that stuff. What we do get paid for is mostly up here, the direct cost and making sure we bring in as much revenue as we can. And a little bit here with some of the indirect costs, which is like marketing. So choosing how to market your location. Are you paying for a marketing firm $1 million, or are you doing your own in-house social media? Okay, next little part is that we're going to talk about inventory. So inventory is, I've had to do inventory for years and years. It's not something that is necessarily fun to do, but it is something that you need to do. So we'll talk about inventory. We're going to talk about different styles of which that you can do inventory. You don't need to know all of them, but there is one style that every single company, I'd say 99% of companies now use. So here he says, not all of our inventory has been purchased at the same price, as is common in the hospitality industry. So prices go up and down, right? One day you buy a ribeye, it's $12 a pound. Next day you buy it, it's $20 a pound. Those kind of fluctuations can happen where they almost go up 50% in just from one time you order it to the next. So varying purchase prices will result in being difficult to determine how much your inventory is worth. Therefore, what you buy it for dictates how much you can sell it for. So the following are the purchase dates for our house red wine, in which we sell most often. So we have 4 different purchase dates, and how many times we purchase, or how many bottles we purchased, our unit cost per bottle, and how much the total cost was. And so what the ask of us will be, how much do we have in value? Now, the actual value is $437. That's what we're looking at right now. We have 17 bottles at $437. That is what we call a specific unit valuation method. So this is the actual purchase price. It's all of the items that we bought at each individual price. Now, the thing is, this is labor intensive, and you're not going to pull a steak out of the fridge and look at it and be like, oh, this is the one that we spent for, that we bought for $12. Let's only sell it for $30. And then you pull up the $20 one and you're going to sell it for $40. It doesn't work like that, right? We sell it at one price regardless. So it's not really used in the hospitality industry. And as I said, imagine charging a different price every time a customer orders a meal because the ingredient prices have changed. It just doesn't happen. Now, so then we look at weighted average. So the first one is actual price. Virtually never used. You don't really need to worry about it. And it's just the actual price of each individual item. The next one is the weighted average valuation. So we're looking, basically what we're going to do is that we're going to find the average that we spent per bottle. So we have all these different unit costs here. So what you do is you take the total cost of units available, which is the total cost of units available, 437, divided by the total units available, 17 bottles, $437 divided by your 17 bottles. On average, it's $27.06 per bottle. Now, I can use that and say, okay, it's $27 what we buy it for. We want a 40% cost on our wine. Then I would divide that by 0.4. And I would find out exactly what I should be charging for my wine. And then I can revisit this every couple months, right? So you don't want to do it every single week where you're changing your price, or even monthly, but you could do it specifically with things like wine. You could do it every couple months. Another one is the first in, first out method. So this is not only an inventory valuation method, but just also the way that we should be moving our food through our fridges. So the oldest product that we bought should be sold before the newer one. That just makes sense in a perishable environment. I want to use the lettuce that I bought 3 days ago for my salad as opposed to stuff I bought today, because the stuff today will be good for a few more days still. This is one of the easiest methods for the industry and helps reduce waste in many food and beverage operations. But when it comes to inventory, it can be quite difficult. So first in, first out. So this is the kind of thing that we might ask you. So on December 31st, we have a closing inventory of 8 bottles of their house wine. What is the total value of inventory in average per bottle? So we know that the last 8 bottles remaining are the latest bottles purchased. So we're looking here. We have 4 different purchase dates. It's just the same graph that we looked at before: December 1st, 5th, 14th, and 26th. And then all the different types or amounts of units purchased and their prices. Now, what we have to understand is that if we have 8 bottles left, because it's first in, first out, the stuff that we bought first would be the stuff sold first. So the 5th stuff, or the first stuff, will be sold. The 5th stuff will be sold. So basically, you go down to the bottom and you count to 8 backwards. So we'll take 3 from December 26th. We need 5 more bottles to hit our inventory of 8 bottles. So we'll take 5 of these 6, and this is going to be our closing inventory: 3 bottles from the 26th and 5 of the 6 bottles from the 14th. And what we're going to do is we're going to find out, okay, 3 bottles cost us 29, the 5 bottles cost us 24. The total for our 8 bottles is $207 per bottle, or $207 total. Therefore, our per bottle cost is about $25.88. And then there's the latest purchase price. Now, this is the one that the industry uses. Okay, they use this the most because it's the idea or the theory behind it is we are going to value our inventory at the price that we bought it the latest or the last. Basically meaning that if we had to buy more, I can only reasonably expect that I'll pay what I just paid. Right? I don't know if it went up or down. I don't have a crystal ball. But if it was $29 last time, I'm going to assume that that's what it's worth, $29. So if you have 8 bottles and they're worth $29 each, that's $232 in inventory. So we looked at a bunch of different styles of inventory. We looked at weighted average, which gave us an average of $27. First in, first out gave us $25.88, and latest purchase price gave us $29. As you can see, there's quite a bit of difference in the value of these individual bottles, depending on what we're doing. So this can vary greatly in huge cost fluctuations. Now, it works out well for us if we're valuing our inventory and we're showing we have more money that we're worth if we do latest purchase price. But this could have been it could have gone down in price and been worth $23. And now we're valuing all of our bottles at $23, even though sometimes we bought them for $29. I hope that makes sense. If it doesn't, don't worry, we'll go over it in class. So this will be an exercise that perhaps we would do. So here we're saying, okay, these are the transaction dates. These are the types of units purchased and the cost for them. Using the 3 different methods, go through and find out what the total cost of units are. So the ending inventory. So we have 12 units that we need. So I'll just do them quickly with you. First one is the weighted average. So weighted average means that we take all of our unit purchase, we multiply by our unit cost, and we get our total amounts, which they're all here already. We add all of these total amounts up. Our 34 units cost us $150. Therefore, we divide 150 by 34. We spent on average $4.43 per. Okay. Our ending inventory is now 12 bottles at that $4.43 is $53.16. First in, first out, we're assuming that the last 12 bottles that we purchased are the ones that we still have left. So we got 8 from December 26th and 4 of the 5 from December 14th at $4.30 and $5.25. Our 12 bottles are now worth $55.40. And then the latest purchase price is the $4.30. We'll just assume that they're all worth $4.30. So we go 12 cans by $4.30, it's $51.60. That's our ending inventory value. And then as you can see here, we have $53.16, $55.40, or $51.60. In this instance, latest purchase price actually brought down our ending inventory, but it doesn't really matter what inventory style you choose as long as you stay consistent. I can't choose this month to use FIFO because it's going to make my balance sheet look better because I have more inventory, right? I'm just always going to use latest purchase price, good or bad. Now, this is what we are going to be doing in class. It gets a little bit more difficult when we buy and sell throughout the month, right? So this might be happen more regularly on items that are very unique. So, if you are selling automobiles, as an example, the prices are going to vary based on how much the parts are, how much you can buy it from the factory. If the factory prices end up going up, you're going to sell it the same way. Same with lots of our retail. And you'll notice now in the world, the global supply chain management, when the costs go up, those individual units go up. So what I bought a dishwasher for a year ago, I won't be able to buy today. And even in 2 months from now, I'm going to have a hard time buying a dishwasher for the same price as I did right now. Right? So we're going to go through this in class. It gets a little bit more detail. I'm sorry about my voice, and I'm sorry I'm just kind of a little out of it. But thank you so much for watching this. Now, I will show you one thing while I have you here. If you are wondering, so I'll be posting this video lecture up in our weekly learning. So this is our Blackboard for that. Under assignments is where we're going to be doing all of our in-class activities. So as you can see here, in-class activities week 1 through 4. So in this particular Excel, if you are looking to work ahead, you will have weeks 1 through 4. Let me just open this up for you. Okay. So you'll have weeks 1 through 4, as well as a little instruction sheet here. So this is what we're going to be doing for our in-class stuff. Now, this particular one is not worth marks. Rather, this is practice while we are working in class together to ensure that we can do it in a test and we can do it for the assignments. So what you'll be doing, so week 1, we'll be filling out all the yellow parts. We'll be using Excel, so we're going to learn a little bit about formulas. This is why it's especially important when you come to class, because we learn all the formulas and we learn how to use these individual sheets. So right now we just finished week 2. There are 2 different exercises for week 2. One of which is just doing a balance sheet and creating a balance sheet. And then the next part is doing inventory valuations based on where we just left off in the PowerPoint. Okay, so that's on Blackboard. You can just look at it, review it, take it down, play around if you want. When we're in class on Monday and or Tuesday, we'll go through both of those. Thank you very much, and I will see you all soon.